Chapter 8, Stocks. In the earlier chapters, we covered the general calculations of annuities and perpetuities. Then in the last chapter, chapter 7, we looked at bonds, which is a real-life example in which we use annuity calculations. Chapter 8 is on stocks, and this is where we can use the perpetuity formula. What are stocks? Stocks are financial securities sold by companies, and they represent company ownership or equity. And bonds were instead financial securities that represent money that a company or a government borrowed from its investors. So let's look at stocks. A little bit more first about stocks versus bonds. A lot of students find the difference between the two kind of very blurred. They feel like stocks and bonds are kind of the same thing. Well, they do have a lot in common. They're both financial securities that firms sell and investors buy, and then investors can then sell them to other investors. So what do stocks and bonds have in common? They both provide long-term funding for the company that issues them. So when a company needs extra money, let's say to acquire its competitor or to expand or to do any other large investment project, it can raise the money by selling stocks or selling bonds or both. From an investor's perspective, an investor can buy stocks or bonds issued by a company, and in return, the company will be providing income to that investor. So what do we call that income? On stocks, the investor will be receiving dividends regularly, and on bonds, the investor will be receiving coupon payments. Also, stocks and bonds can be sold when the investor feels like selling them, and that provides potentially, a capital gain to the investor. Both stocks and bonds make future payments periodically, dividends for stocks, coupons for bonds, and both can be purchased in a marketplace at some today's price. From the firm's perspective, bonds represent the firm's long-term debt. A firm borrowed money long-term. It needs to be paid back with the interest on top over many years. Stocks, they represent equity. So the words equity and stocks are used interchangeably, and the words debt, loans, and bonds are also used interchangeably in finance. Where do we see stocks and bonds in balance sheets? Well, bonds or long-term debt are under liabilities. Stocks or equity is under common stock, which is bottom right of a balance sheet that we call equity. In an income statement which shows what happened to a firm over, let's say, 1 year, right, rather than a snapshot. So over 1 year, a firm made some money, that sells revenue, and then we subtract all sorts of expenses, one of which is called interest. That's interest on loans, which is essentially coupon payments on bonds. And then later, in this specific order, we then subtract taxes, we get net income or profit for the year, and profit can then be distributed among the stockholders, the owners of a company. And the owners of a company receive payments on their stock shares, known as dividends. Another comparison of stocks and bonds in terms of their payments. Bonds pay last on maturity date, so there is an end to bond payments. Stocks pay indefinitely, in perpetuity. It's a never-ending stream of cash flows. Bonds pay coupons every year, same coupon amount typically, which is why bonds are annuities. And also there is an additional payment at the very end called face value at maturity. Stocks, they just pay dividends every year. What do coupons look like for bonds? Typically, they're fixed every year, so we have the same coupon amount every year, or maybe every half a year if coupons are semi-annual. Dividends can actually change every year. That's why on this sample timeline I put D1, so dividend in 1 year, D2, dividend in 2 years. If I wanted to indicate that the dividends are the same, then I would not, differentiate the notations with subscripts 1, 2, 3, and so on. I would just use the same, let's say, capital D for all dividends. So we're talking about stocks in this chapter. There are actually 2 types of stocks, and we probably already saw both examples in the early chapters, but let's, kind of structure it a little bit. Common stock and preferred stock. Common stock is the most common type of stock. This is where the name comes from. The dividends are higher when a company has higher profits, when it was a good year for the company, so it can afford to pay more to each stockholder. Or the dividends can get lower. Maybe the company's pauses paying dividends for a while, so the dividends can even equal $0 for a while. Preferred stock has preference over common stock in the sense that when the firm distributes its net income among the stockholders, those stockholders that hold shares of preferred stock will get their dividends first. That's why buying a preferred stock is a much safer investment. You're more guaranteed that you will receive your promised dividends in the future. This is a less common type of stock. Not all companies have it. What's so special about it is that dividends are fixed, so it's always the same dollar amount, and they're usually guaranteed. So for example, a company may pay a $2 dividend every year to investors who buy its preferred stock shares. Preferred stock holders also have preference over common stockholders in receiving dividend and in distribution of firm's assets in bankruptcy. So to summarize, firms need to pay money to 2 main groups of investors: stockholders and bondholders. Who gets the top priority? It's the bondholders. If you recall the income statement from the early slides, interest payments on debt appear early on in an income statement. And then net income is distributed as dividends, at least partially, and the top priority is to the preferred stockholders. And only then the holders of common stock receive their dividends.